A staggering 60% of millennials say they distrust financial markets.
This game is rigged, man.
And only 1 in 3 have any money in the stock market at all, despite it being the best vehicle for building long-term wealth and financial security. Due to this distrust, as well as fear and a lack of knowledge, many people are hurting their financial futures. But investing doesn't have to be hard, and it doesn't have to be risky, as long as you stay focused on the long term and do it the right way. Today we're going to be talking about 3 keys to investing that anyone can use to be successful in their financial futures.
Tell me more, tell me more.
The first key to successful investing is be average. Just be an average Joe investor. Now this runs counter to a lot of what we're taught as Americans, even from a young age. From a young age we're taught we need to be the best in whatever we do.
I want to be the very best.
But when it comes to investing, this is not a good strategy, because even financial professionals struggle to deliver superior returns.
Show me the money.
Less than 20% of actively managed funds outperform just a simple S&P 500 index fund. Now, an actively managed fund means that a financial professional is picking stocks, picking which ones to own, picking when to own them, how much of them to own. An index fund is going to be tracking a particular index, so the most popular one would be the S&P 500. If you own an index fund, you're going to own parts of all 500 companies in the S&P 500, and you're going to own more of the big companies and less of the small companies. It's going to be weighted according to how big those companies are. In an actively managed fund, he's going to be trying to time the market. He's going to want to pick the best stocks and own them at the best times.
Together we shall cast ourselves into the future.
Now, you would think a financial professional is going to be able to do better than someone who just owns all 500 stocks and doesn't buy and sell them and just keeps rolling along with whatever happens. But 80 to 90% of the time, that's not the case. 80 to 90% of the time, you're going to be better off being in that passive index fund where you just own that entire basket of stocks and you don't touch it. So the best thing you can do as an investor is to settle for that solid B average. Don't risk getting an F just so you can chase after that A. The second key to successful investing is to do less.
Don't do anything I would do. And definitely don't do anything I wouldn't do.
Now, a lot of these reasons go along with why active managers have such a hard time beating the market. Brokerage commissions, bid-ask spreads, and tax implications, along with just the sheer difficulty of trying to time the market, are reasons why actively managed funds do a poor job, and they're a reason why individual investors sometimes do a really poor job if they're trying to time the market, buy and sell a lot of stocks. Obviously, every time you buy a stock, you're going to have a brokerage fee. There are some no-cost brokerages such as Robinhood, but even with those, you're still going to have a small bid-ask spread that's going to add a little bit to the cost. Another big thing, though, is tax implications.
I tell you, Uncle Sam.
Tax rates for short-term capital gains, so for any capital gains when you sell a stock that you've owned less than a year, are much higher than taxes on long-term capital gains and on dividends. So if you're buying and selling stocks a lot, stocks that you've held for less than a year or funds that you've held for less than a year, you're going to be paying short-term capital gains taxes on those, which are taxed at the same level as your income. Long-term capital gains and dividends are taxed at a much lower rate, and if you're in the lower income tax brackets, there's no federal tax on those at all.
Tax-free?
Tax-free. IRS can't touch 1 cent.
On top of all this, timing the market is almost impossible to do on a consistent basis. I mean, this goes back to point number 1. Actively managed funds just don't perform well compared to index funds. And if a financial professional can't time the market very well, then odds are you probably can't either. To summarize, doing less will allow you to avoid costly brokerage fees and taxes, as well as prevent you from making bad decisions trying to time the market. So do less and make more. The third key to successful investing is to stay the course.
Stay the course.
If you're not careful, fear and greed will eat heavily into your returns in the stock market or any of your other investments. So many investors buy high and then sell low. And the reason for that is people get afraid when stocks are low and they get greedy when stocks are high. When they're high, people think they're going to keep going up.
Well, we're moving on now.
And in the short term, that may work out, but eventually those things are going to go back down, and then people get afraid. And that fear of losing their money causes them to sell at usually the worst time.
You idiot! Get back in there at once and sell!
A study by Dalbar Inc. out of Boston looked at the years 1993 to 2012, and they compared the returns of the S&P 500 to that of the average individual investor. The S&P 500 during those 20 years averaged a return of 8.2% per year, but the average investor only got 4.2% per year over those 20 years. Now, why is this? Because those investors tried to time the market. Those investors sold when they got afraid when stocks were low, and they bought more and more when stocks were high. Now, you may say 4% still sounds pretty good. It is half of 8, but it's a lot better than 0. And you're right, it is better than 0. But take an investment of $10,000. If you had invested $10,000 and made 8% a year for 20 years, you would have over $46,000 after those 20 years. If you return just that 4.2%, you would have just shy of $23,000. So once you've decided how you're going to allocate your investments between stocks, bonds, what type of funds you're going to put it in, leave those funds there. Just buy and hold. You want to be a buy and hold investor. And don't let fear scare you out of the market. Don't let greed lead you to try to switch to a different type of fund or a different type of stock. Stay the course. The stock market is always going to go up and down. It's a roller coaster. It's better than your average roller coaster, though, because in an average roller coaster, you go up and down and up and down, and you end up back at the same spot. In the stock market, you're going to have ups and you're going to have downs, ups and downs, but you're going to end up a lot higher than when you started. One book I really recommend is Unshakable by Tony Robbins. It's a great book that will educate you about the stock market.
Knowledge is power. Don't you want to feel powerful?
In Unshakable, Tony Robbins teaches you about the stock market, how the stock market works, what happens when it goes up, what happens when it goes down, the fact that it does go down all the time. Historically, it's gone down a bunch of times. But every time it went down, it went back up. So what makes you think this time is going to be any different? And when you have that knowledge, when you know the history that shows that the stock market, yes, it's going to go down, but it's going to bounce back up, it can help you get rid of that fear, purge that fear, and be secure in the knowledge that, yeah, checking that 401k right now, checking the balance in that IRA or in that brokerage account is a little painful because it's going to be in the red. It's going to be a lot lower than it was a couple months ago last year, and you're going to be tempted, it's going to go down more. I just know it's going to go down more. I can't afford to lose any more money. I don't want to lose any more money, and you're going to be tempted to hit that sell button. Don't. Stop it.
S-T-O-P, new word, I-T.
Don't hit that sell button. You need to stay the course, because eventually those stocks are going to go back up, and you don't want to miss out when they do. The worst mistake you can make when it comes to investing is to sell low, because you're locking in those losses, and you may not be able to get them back. So those are your 3 keys to successful investing. Be average, do less, and stay the course. Sounds pretty easy, and really, it is. It's not going to get you rich quickly. It's not a get-rich-quick scheme. But it will get you rich slowly if you do it the right way.